My life takes place behind my trading screens. Therefore, I need to make sure that the information displayed on those screens is organized properly and is relevant. Not just to help me make money, but also to allow me to manage the risk of my existing positions. My screen is divided into my position management system, my news services, and my real-time market data. There are also many charts on my trading screens, but these are just an easy way of displaying some of the information I look at. The position management system shows me all my positions and how much money I'm making or losing. It helps me understand the risks in my portfolio and when I should be thinking of cutting my positions. If you have a brokerage account, your broker should give you their system to keep track of all this. My news comes from Reuters and Bloomberg, but also from Dow Jones and even from Twitter. I also look at many websites from companies such as the Wall Street Journal, the Financial Times. If you want to see a complete list, please go to my website, lexvandam.com. Let me also explain why it's so important to have the right market data in front of you. It's a big world out there, and these days everything is correlated. By that I mean, whatever happens in Asia has an impact in Europe and the US, and whatever happens in equities influences what happens in currency markets, and sometimes in commodity markets as well. Most people don't have time to read about all the fundamental developments in all other asset classes. A good trading screen will have information about stocks, currencies, commodities, and the economy, so you can quickly see what's happening in the world and whatever you need to focus on right now. Another reason to spend a lot of time building a good trading screen is the following. Sometimes there's a lot of good news in the world and the economy is looking great. Everybody around you is bullish, and it is no longer a question of buying stocks in general, but about which stocks to buy to get the most bang for your buck. It feels as if the market will never go down again. But then the market suddenly drops like a stone and your portfolio gets destroyed. Or sometimes the news about the world situation is so bad that you would rather stay in bed. There's too much debt, too much unemployment, and too much inflation. The right strategy seems to be to sell the market and sell every stock. But then the market suddenly starts flying, and this time your shorts get killed. A good trading screen will hopefully give you warning signals about an imminent change in the market direction long before the newspapers will report about it. That will allow you to reposition your portfolio before it is too late. That is why this module is so important and why I want to share with you some of the most important data that I look at on my screens. On top of that, a good trading screen will give you plenty of inspiration and ideas for new trades. Every trader should have a trading screen set up for their own specific needs. Hopefully mine can form a good basis for yours, but as always, check every bit of data on there to make sure it is valid before you use it. My trading screen will change over time as well, as the market changes, and so should yours. Also, never make a trading decision without going through each of the 5 steps. The real-time data I am talking about can be divided into 3 groups. The first group is price data, such as the level of the S&P 500 or the FTSE, or the price of copper in currencies. But it also includes interesting economic data, such as the amount of credit that's available in the economy. The second group of data I look at is survey data, such as retail sales and unemployment and the ISM manufacturing number. But I also look at surveys regarding investor sentiment to see if people are generally bullish or bearish. And the last group is derived data, such as the volatility of the price, as we discussed in step 3 under chart analysis, or the number of stocks trading above that 200-day moving average. Let's start with the price data. Price data is information that is based on actual transactions. It's data that can be measured, such as the price of a stock or commodity, or the amount of freight that's being transported across the railways. Right now I will only discuss the most important ones that I look at. The workbook accompanying this module will give you a much longer list of instruments if you like to learn more. Bear in mind though, this list will change over time as the world changes. It might be that today I look at data regarding China, maybe tomorrow I will look at other data, maybe India or maybe somewhere else. So keep an eye on my website for the latest instruments that I'm following to make money. Country indexes. So there are 6 stock market indexes that I follow most closely. In the US, I focus on the S&P 500, which tells me how the largest stocks are performing, and on the Nasdaq, which is more technology oriented. In Asia, I look at the Nikkei 225 for Japan, and I look at the Shanghai Composite for China. The Euro Stoxx 50 indicates to me what's going on in Europe, and the FTSE 100 keeps me in touch with the UK. This chart shows 4 of these 6 indexes, with the S&P in white, the Nikkei in red, the Euro Stoxx in green, and the Shanghai Composite in purple. You can see that Japan and the US did really well over this period, but that Europe and China were very much going through a very tough patch, both being down more than 20%. Looking at the absolute and relative performance gives you indications about what's going on around the world and where the action is. In particular, if there's a change of trend somewhere in the world, this might have implications for your trading strategy and also for your portfolio. I tend to go where the action is. If a lot is going on in Spain, the Spanish IBEX might also be very relevant. At other times, the Bovespa in Brazil could be the one to watch. Sector indexes. Let's now move on to the next group of price data that I closely watch. The three sector indexes I follow most closely are the semiconductor index, the financials and the healthcare sector. I look at the semiconductor companies because they are used in virtually every process in industry, from machines in factories to phones. So semis tell me about industrial activity as well as consumer demand. If this industry is selling more products, it probably means that the whole economy is improving. My preferred proxy is the liquidly traded ETF called SMH. Again, a sector ETF is a simple way to get exposure to a large amount of stocks in one industry. Financials are also a sector I like to watch, because an economy is only as strong as its financial sector. Weak banks can't lend, and without credit, most companies can't grow. So for me, to want to buy stocks, I would like to see the bank sector perform well. The index to look at is the XLF ETF, which tracks the financial sector pretty well, and is also a very liquid instrument to trade. The third sector I look at is the healthcare sector, which is a defensive sector because people need medication, independent of the current state of an economy. It can be traded through an ETF called XLV. Here we see the chart of financials in yellow, semis in grey and healthcare in green. The S&P 500 ETF SPY is the purple line. You can see that this was a period where the healthcare sector underperformed financials and semis. People were clearly adding risk to their portfolios. It is interesting to watch all these three sectors at the same time, to get a feel for what investors are thinking. Sometimes people buy financials and buy semis, but sell healthcare, which is, as we just said, a way to make a portfolio less defensive. Or they sell financials and sell semis, but buy healthcare, which is also a sign of sector rotation, but means that people are getting more nervous about the general market. If all three sectors perform badly, people may be taking money out of stocks altogether, and that's even more worrying. In any case, these three sectors and the way they behave versus one another tells me a lot about the health of the economy and of the situation in the general stock market. I also look at other sectors, of course, but different sectors being important at different times. If the housing sector is a key theme, I will keep a close eye on the home builder ETF. And if consumer spending is important, I will look at the consumer discretionary sector. This includes, for example, car companies and hotels and leisure. On a related note, when you trade a country index, be aware that this might not achieve what you want it to. For example, the Swiss index is heavily weighted towards healthcare stocks, and the Swedish OMX index is weighted towards industrials. The Hang Seng in Hong Kong is very much a financial and property play, so a country index might be as much a sector play as a country play. Style indexes. Let's now move on to the next set of price data I like to look at. When the economy is doing badly, people tend to buy large liquid companies that are safe and defensive. When the economy is doing well, they tend to rotate out of these into smaller, more aggressive companies. That is why I like to look at the price ratio between large companies and small companies. In practice, this means I follow the ratio of the S&P 500 versus the Russell 2000, which is a small cap index. Small cap means having a low market capitalization, i.e. being a relatively small company. I trade this through the ETF called SPY for the S&P 500 and the Russell 2000 ETF called IWM. If I want to put on a trade that reflects flight to safety, I will buy the SPY and short the IWM. Another way to look at what is going on in the market is to compare stocks with low PE ratios to stocks with high growth rates. If the market is nervous, then cheap stocks with low PE ratios tend to outperform expensive stocks with high growth rates. As always, there's an ETF for value stocks and an ETF for growth stocks as well. To be even more complete in our style analysis, I also want you to follow the SDY ETF, SDY ETF. This one looks at high dividend paying stocks. It will do well when people focus on getting paid a dividend, as opposed to buying stocks for capital appreciation. In this chart, the S&P ETF is in yellow. So this basically represents the performance of the whole S&P 500. The purple line is the growth ETF, which has done better than the general market over this period. The value VTV is in green. The small cap IWM is in grey. And the dividend SDY is in red. So the small cap and the value and the high dividend strategies underperformed the general index. It was a period of people making their portfolios more risky as opposed to more defensive. The one thing that is slightly funny here is that the large cap outperformed the small cap, which is not what you would expect when growth did so well relative to value. Currencies. Of course, I also look at currencies, and then particularly the euro, the Australian dollar, the Japanese yen, the Brazilian real and the Singapore dollar. All, of course, versus the US dollar. Currencies move around for many reasons, but in general, the stronger the currency, the harder it is for a country's export industries to make money. Here you can see some currencies versus the US dollar. Currencies are always quite hard to read, so it takes a little experience. But basically, this chart shows that the yen, which is the purple line, has weakened by 6% over this period. A good reason to watch the Japanese yen is that it is the third largest economy in the world, and it has a currency that has been way stronger than it would have liked to be, which has hurt the economy. A falling yen might also give me some trading ideas with regards to, for example, Japanese exporters, which would be large beneficiaries of a falling yen. The Brazilian real, in red, is important because it is such an up-and-coming economy. A strengthening currency might well cause a slowdown, which could have an impact on global trading patterns. The Brazilian real initially strengthened, but is now back to flat versus the US dollar over the period. The euro in white tells me about how worried people are about European debt. It weakened in the first few weeks, but then strengthened and is up small at the end of this period. That is not what you would have expected when you had read newspapers at the time. The Australian dollar in yellow is a commodity currency and tells us about global demand for copper and iron ore. If China needs a lot of copper, they will inevitably buy from Australian companies and thus need Australian dollars to pay for that. And this will lead to the Australian dollar to strengthen. It went off to the races in the first 2 months of the year, but has now given that back, implying that the demand for copper might be flattening off and the economy may be deteriorating. The Singapore dollar, here in green, is a good indicator for the strength of the Asian economies. It has been stronger all year. The Asian economies seem to be in a relatively good shape based on this currency. Interest rates. You can't trade stocks without having a feel for the cost of money, and the way to look at the cost of money is through interest rates. Low interest rates are good for countries and companies, as they can access money at very low rate. Also, when rates are low, people don't like to keep their money in their bank accounts, as it earns very little interest, and might instead decide to buy stocks. So low rates tend to be good for stocks. Regarding interest rates, I normally look for the US at 3-month rates, 2-year rates, 10-year rates and 30-year rates. The reason I look at all these different time frames is to get an idea of how the interest rates vary over different periods. This will give me a good idea about what stage of the cycle an economy is in. If short rates are low compared to long rates, it normally means that the economy has support from the central bank. If the short-term rate is high, it tends to mean that the central bank is trying to slow the economy, perhaps to avoid higher inflation. Together, these interest rates form the yield curve, and you can see on this chart that short-term rates are significantly lower than long-term rates. For other countries, I tend to look mainly at 10-year interest rates, and here I focus on Germany, Italy, Japan and Brazil. Here you see Italy in purple on the far right scale, with rates over 5.5% on the 10-year bond. The reason I'm focusing here on a country like Italy is because of the debt crisis in Europe, but that will undoubtedly change to another country at some point in the future. I also like to look at Japan, here in green, because it's a very advanced economy with an aging population. They have a lot of debt, and if the Japanese 10-year rate starts going up, they will be in a lot of trouble. The US in yellow is always the benchmark, and the German yield in white tells me a lot about flight to safety in Europe, especially from countries such as Italy and Spain. An easy way to trade US fixed income instruments is once again through ETFs. There's an ETF for short-term government bonds, there's one for medium-term bonds, and there's one for long-term maturities. I also like to look at American municipal bonds, with a lot of local governments running out of cash. If municipals have to pay more interest on their debt, that could become a huge issue as well. Of course, I also look at bonds from companies, also called corporate bonds. Here it's important to look at the good investment grade bonds, but I also like to watch the more risky corporate bonds. Here you can see that long-term bonds in green have done worst, and municipal bonds have done best. You can see all the tickers I use on the chart as well. Of course, I'm not suggesting you trade all these ETFs. The main goal here is to watch the very liquid instruments that I have pointed out on your trading screen, so you know what is really going on in the markets today. Commodities. Copper and other commodities can be great tools to predict economic prospects. The price of copper is probably the most widely followed leading economic indicator, and is often called Dr. Copper, for its ability to predict market moves as well as the economy's health and trends. Copper is shown here in purple. Crude oil, here in green, is obviously also very important, with a higher oil price confirming a growing economy. But an oil price that is too high will actually slow down that same economy. The one that is really important is the CRB RIND index, which consists of components that industrial companies use as an input into their production process, such as copper, scrap, cotton, rubber and lead. That gives you a better idea of how busy the factories really are. So in this section, I look at these three when I try to form an opinion on the economy. Of course, I always also look at the price of gold. It tells me about the printing of money by the government, and when people move money into gold, it must be because they are quite scared of the future. Why else put your money into an asset that just lies in a safe without producing anything useful on the back of it? There are three more price series I would like to discuss here. The first is bank loans, the second is railroad traffic, and the last the Baltic Dry Index, which looks at shipping prices. Together, these will give me an even better picture of the economy and forthcoming changes, so I can prepare and protect my portfolio. Bank loans. I like to watch the total bank loans outstanding in the US economy. The reason is that it is important to see how many loans banks are actually making to companies. This is a number that is provided weekly by the Federal Reserve in the US, and the slide shows that it is in the region of about $10 trillion in mid-2012. Typically, for a healthy recovery to occur, more loans will be demanded by companies and banks will be able to provide these loans. Of course, the more credit there is available, the more the chance of inflation. So that is of course something you would have to keep in mind at the same time. When credit disappears, it's likely that the market will find it hard to go up, and that is why I like to keep an eye on these bank loans. Railroads. Another indicator I look at is the total amount of carloads that railway lines in the US carry, which again is not a great indicator of what is actually going on in the economy. If the amount of products they carry falls, it is a good leading indicator for the economy getting worse. While if the amount that rails transport increases, it means the economy is expanding, as businesses require more materials and consumers are buying more goods. The slide shows that over 500,000 carloads are transported per week in the US. The fact that the graph is quite flat means that railroad activity is not supporting the economy. Right now, all this might not be super significant, but when there is a big drop in activity, it might really be a very important warning signal. Baltic Dry Index. The previous data is quite US focused. The reason I look at it is that the US remains the most important economy in the world. In 20 years' time it might be China, but until then we will live in a world dominated by the US. But of course there is a lot else going on in the world that you need to be aware of. That is why I also look at the Baltic Dry Index, which gives an indication of demand and supply of global shipping capacity for dry bulk, like iron ore or wheat. If the Baltic Dry Index goes up, it means companies are renting ships to transport this kind of bulk cargo around the world. That is an indication of a global economy that is improving. Between 2011 and 2012, the Baltic Dry collapsed because of a total overcapacity of ships around the world. So a falling index doesn't always mean a lack of demand. It can also mean oversupply of ships around the world. The second type of data I look at are survey data. They can be either economic or investor sentiment based. Survey data is based on questioning a small group of consumers or companies about their confidence in the economy, their product sales, or sometimes even their view on the stock market. The key here is that it is based on a sample, as opposed to actual transactions. We are only going to focus here on weekly data to ensure that we stay as current as possible. The monthly ISM is great, but we don't want to look at a number every single day on our screen that only changes once a month. You would rather use the space on your screen for something else. Anyway, we will discuss a few more extremely interesting monthly indicators in the workbook, but let's focus here on weekly surveys. The first is the Bloomberg Consumer Comfort Index, which tells you how comfortable an average American is about their finances. The idea is that when someone feels confident about their financial situation, they will go to the shops and spend more money. So this is an indication of the health of the economy from a consumer perspective. Related to that is the weekly initial jobless claims, which again has a big impact on consumer spending and consumer confidence. Employed people have more money and feel more secure. This means they will probably spend more and stimulate the economy, leading to further job creation. Another weekly survey asks investors if they are bullish, neutral or bearish on the stock market at that moment. This is called the AAII Investor Sentiment Survey. The indicator is calculated by dividing the number of bulls by the number of bears. A high number suggests investors are very bullish, whilst a low number means that investors are very bearish. The idea is to use it as a contrary indicator, and that whenever most people are bullish, the market has room to fall. And whenever everybody hates the market and is bearish, it might be a good time to buy. Be careful though, to never use any number in isolation to make investment decisions. They can easily trick you. So these are the 3 survey data I like to watch. The third group is derived data. Here the main indicators to look at are the following. The first is the VIX index. This tells me about the volatility expectations in the market, which of course I mentioned before. Here's the chart of that VIX index again. As you know, this is a contrary indicator. If the VIX is low, people are complacent, and the market as a whole doesn't expect a lot of turbulence in the near future. That might be a sell signal. If the VIX index is high, people are bearish and nervous and will have sold some of their holdings. That might be a good buy signal. I also like to look at the percentage of stocks above their 200-day moving average. The 200-day moving average is the average price of a stock over the last 200 days. If you had bought a stock every day over the last 200 days in the same quantity, this is the price you would have paid on average. If the stock is today trading above that average price, then you would have made money. If a lot of stocks are trading above the 200-day moving average, then that means that the market has a very broad participation, which is very bullish. However, if too many stocks are trading above this moving average, the market is likely overbought and could pause or even start to come down. The opposite is also true. For example, if 80% of the stocks are trading below the 200-day moving average, it might be a great buying opportunity. Anyway, in this chart, 64% of the stocks on the New York Stock Exchange trade above their 200-day moving average, which can be considered pretty bullish. The next 3 indicators I use are actually produced by Citigroup and are known as the Citigroup Economic Surprises Index, and tells you if economic data is surprising to the upside or not. Basically, they show the difference between what the actual economic data is and compare it to what the economists estimated that data will be. The higher the index, the more economic releases have managed to beat estimates, while if the index falls, it means the economic data is worse than the economists had expected. This is the US chart, and it shows that recent US economic data has started to disappoint versus expectations. The same is true in Europe. And also in Asia, as the economy has been slightly weaker than expected. And here's the summary of the derived data I look at. Of course, my screen would not be complete without looking at individual stocks. But I don't want to tell you which stocks are important, as there are tens of thousands to choose from, and I don't want to bias you in any direction. Maybe just start with a few big companies in different sectors, and add ones that you come across as you dig deeper into the stock market. I will leave it to your own imagination to decide which stocks are relevant to your own specific situation. Putting this all together, and my trading screen would look like this. It has country indexes, sector indexes and style indexes. It looks at currencies and commodities and interest rates. And it has quite a bit of other data, as we discussed before. It will tell you an awful lot in a very short time period, and hopefully it can form the basis for your trading screen as well. I will not repeat why a good trading screen is so important, but hopefully by now you feel excited enough to use some of these short-term indicators as well. Also be aware that no matter how good these indicators are, it is always possible that they can put you on the wrong foot. And remember, whenever they have worked for a while, they then tend to stop working for a bit. So please be careful about following them blindly. They are just a few ingredients in a very complex mix. I hope this module has given you some ideas about what your trading screen could look like. As always, good luck and happy trading.